First Majestic Silver Corp, AG, is positioned as one of the world's most significant pure-play silver producers, offering investors direct and highly leveraged exposure to the anticipated parabolic price appreciation for silver.
The fundamental investment thesis rests on the expectation that the company's aggressive internal growth trajectory and its disciplined cost structure will combine to maximize operational leverage against a backdrop of persistently favorable commodity price mechanics. The company demonstrated exceptional operational momentum during the third quarter of 2025. This period was characterized by record quarterly revenue of $285 million.
$1 million, marking a striking 95% increase compared to the corresponding period in 2024. This dramatic revenue expansion was directly attributable to dual factors: a 45% increase in silver equivalent AGEQ payable ounces sold, and a 31% increase in the average realized silver price, which reached $39.03 per AGEQ ounce during the quarter. This performance confirms the success of management's strategy to integrate new acquisitions and optimize existing assets for maximum throughput.
Despite this robust operational performance and surging revenue, the equity currently trades at a significant premium, presenting a nuanced valuation paradox. The stock is assigned a highly demanding price-to-earnings ratio, which has been recently observed ranging from approximately 83.89 times to 114.5 times trailing earnings. This valuation multiple is significantly higher than the peer average PE of 45.9 times.
Such a steep premium suggests the market is not pricing the stock based on current profitability, but rather is aggressively discounting massive future earnings growth, estimated by some models at 71.16%. This expectation is contingent upon the sustained rally in the underlying commodity price. The extreme price-to-earnings ratio currently assigned to the company is a market function reflecting the expectation of an explosion in future cash flow, which has not yet fully materialized.
This aggressive valuation is not a measure of the company's current profitability based on the $39.03 realized price achieved in Q3 2025, but rather a mechanism for anticipating and discounting the future profitability expected under the forecast environment of $60 plus realized prices. If the projected high growth rate of
16% does materialize as silver prices enter the consensus $55 to $88 per ounce range, the forward PE multiple would contract rapidly, retrospectively justifying the current share price. Consequently, the equity is highly susceptible to any shift in macroeconomic sentiment or operational execution that might compromise these high growth expectations.
Furthermore, a deeper analysis of the quarterly results reveals that the Q3 2025 revenue fell short of analyst expectations, missing the forecast of $311.86 million by 8.58%. This discrepancy, however, appears to be a function of management's deliberate strategic decision regarding inventory management. The company confirmed that it held approximately $50.3 million worth of silver and gold inventory at the quarter end.
Had this material been sold at Q3 prices, the total revenue would have amounted to approximately $335.4 million, significantly exceeding the analyst forecast. This action is a powerful indication of management's high conviction in the continued strength of the silver rally, whereby they intentionally sacrifice short-term earnings per share (EPS) figures to maximize future realized prices, demonstrating a clear prioritization of long-term asset value capture over short-term market optics.
B. Preliminary risk-reward assessment. The primary risk associated with an investment in First Majestic Silver stems directly from its high valuation. The demanding multiple exposes the stock to significant price volatility and potential punitive market reactions in response to any operational delay, cost overrun, or financial miss. This sensitivity was demonstrably evident following the release of the Q3 2025 results, where despite record operational output, the earnings per share of $0.07 missed the analyst expectation of 11 cents by 36.36%, leading to immediate negative market adjustments. Conversely,
The potential reward is dramatically levered to the silver price achieving the conservative consensus 2026 forecast range of $55 to $65 per ounce, given that the consolidated all-in sustaining cost remained competitive at approximately $20.
90 per Ag ounce in Q3 2025, a price environment above $55 per ounce promises a radical and disproportionate expansion of the company's operating cash flow margins. The investment profile, therefore, demands a risk tolerance for high volatility, positioning the company as a high beta expression of a bullish silver outlook. I. The structural imperative, analysis of the global silver market dynamics. A. Supply-demand imbalance and structural deficit.
The investment thesis for silver, and consequently for First Majestic Silver, is anchored in the structural dynamics of the global silver market. The market is currently defined by a profound and persistent structural imbalance, with the global silver supply deficit having entered its fifth consecutive year. Projections from institutions like the Silver Institute forecast the shortfall for 2025 alone to be approximately 117 million ounces.
This projected deficit is among the largest observed in recent history and continues to exert material upward pressure on prices. Contributing significantly to this imbalance is the systemic inelasticity of silver mine supply. Global mine production remains largely stagnant, hovering around 813 million ounces annually. This rigidity in the supply curve is due to the inherent difficulties and protracted timelines involved in bringing large new primary silver projects online.
For a company focused almost entirely in silver production, such as First Majestic, the continued existence of a structural deficit ensures a favorable pricing environment and reduces the threat of new supply overwhelming demand. B. Dual demand drivers and price forecasts. Silver benefits uniquely from dual demand drivers, differentiating it from gold and positioning it to capitalize on both macroeconomic uncertainty and accelerating technological adoption.
The first driver is industrial consumption. Silver is indispensable in various high-growth industrial and technological sectors, providing a crucial floor to its price. Its utility in electronics, the automotive industry, medicine, and particularly green energy technologies ensures robust demand independent of monetary policy.
Specifically, consumption in solar panels, photovoltaics, accounts for approximately 16% of global demand and is projected to grow substantially, estimated at 14% annually. The expansion of manufacturing, especially in response to clean energy mandates, continues to boost silver consumption. The second key driver is its traditional role as a monetary metal and inflationary hedge. Persistent inflation and elevated geopolitical risks bolster silver's appeal among investors. This convergence of industrial and investment demand has led to significant price escalation, with silver having surged 114.6% in 2025 alone, notably reaching over $60 per ounce at one point and outperforming gold. Analyst projections reflect this momentum, with average price forecasts for 2025 situated between $36 and $38 per ounce, and some forecasts reaching as high as $40 to $46 per ounce. Looking ahead to 2026, the outlook remains highly constructive. Major financial institutions anticipate silver trading robustly between $55 and $65 per ounce throughout the year, with consensus year-end targets around $63.78. More aggressive forecasts, driven by technical breakouts that suggest a move into price discovery move, place potential targets as high as $72 to $88 per ounce by late 2026. The pronounced difference between the company's competitive cost structure and the anticipated future price environment creates a high leverage multiplier effect. For a primary silver producer like First Majestic, which maintains a relatively stable all-in sustaining cost, every incremental increase in the market price of silver translates almost entirely into a direct expansion of the profit margin. In the third quarter of 2025, with a realized price of $39.03 per AgEQ ounce and an AISC of $20.90 per AgEQ ounce, the operating margin was $18.13 per ounce. Should silver prices reach the conservative 2026 forecast of $55 per ounce, assuming cost stability, the margin would expand significantly to $34.10 per ounce. This represents a substantial 88% increase in margin for only a 41% increase in the commodity price, showcasing the extreme operational leverage embedded in the equity, which is the core factor justifying its premium valuation.
Furthermore, market trends suggest a potential decline in the gold-silver ratio, which is forecasted to fall into the 70 to 82 range in 2026. Historically, a declining ratio indicates that silver is outperforming gold, often occurring during the later, explosive stages of a precious metals bull market. Given that First Majestic derives a majority of its revenue from silver sales, 56% of Q3 revenue, the company is optimally positioned to capture this relative outperformance, maximizing portfolio returns compared to producers with a higher weighting toward gold. II, Operational Review and Cost Structure Proficiency. A, Production and Throughput Performance. First Majestic Silver achieved significant operational milestones in 2025, driven by successful integration of new assets and organic growth at established mines. The company's Q3 2025 production amounted to 7.7 million AgEQ ounces, representing a substantial 39% increase compared to Q3 2024. This record production was primarily underpinned by a massive 96% increase in attributable consolidated silver production, reflecting the critical contribution of the Los Gatos silver mine, acquired in 2024, as well as robust internal growth leading to a 27% production increase at the flagship San Dimas operation. These achievements place the company firmly on track to achieve its upwardly revised 2025 production guidance, set between 30.6 and 32.6 million AgEQ ounces. Management anticipates further production growth in 2026, particularly through increased throughput at the newly acquired Los Gatos mine and the Santa Elena operation, with detailed guidance updates expected in January.
B. All-in Sustaining Cost AISC Analysis. The company demonstrated commendable cost discipline during its expansionary phase. The consolidated all-in sustaining cost AISC for Q3 2025 was reported at $20.90 per AgEQ ounce. This figure represents a
slight 1% reduction from the $21.03 per AgEQ ounce reported in the third quarter of the previous year, highlighting the company's ability to maintain cost stability even amidst an intensive operational ramp-up and the integration of the Los Gatos.
Acquisition. Management noted that when applying the company's updated 2025 guidance assumptions regarding metal prices and the USD/MXN exchange rate, the theoretical AISC for Q3 2025 would have been $19.41 per ounce. The full year 2025 AISC guidance
remains competitive for a primary silver producer, targeted within the range of $20.02 to $20.82 per AgEQ ounce. The discrepancy between the reported Q3 AISC of $20.90 per ounce and the management-adjusted figure of $19.41 per ounce, a material
difference of $1.49, largely stems from the volatility inherent in foreign exchange rates and specific metal price assumptions used to calculate silver equivalent grades. Given that the majority of First Majestic's operational expenditures are incurred in Mexican pesos, MXN, a strengthening of the MXN relative to the US dollar directly increases reported dollar-denominated costs. The company's achievement of its full-year AISC guidance is therefore heavily predicated on favorable currency movements and the specific pricing utilized for silver equivalent calculations. Investors must recognize that the actual operating margin is subject to greater volatility than the cost guidance might imply, being contingent on macro financial factors outside of management's direct control. C. Portfolio and project development. The company's growth strategy has been heavily focused on strategic capital allocation and high-impact exploration. The successful acquisition and
integration of the Gatos silver asset in 2024, including the Cerro Los Gatos mine, was the primary driver behind the massive production increase seen in Q3 2025. This expansion of the operating base necessitated a 34% increase in the 2025 capital
expenditures guidance. A major organic success story is the high-grade Navidad discovery at the Santa Elena property, which was delineated in 2024. This new vein system is deemed the most promising discovery at Santa Elena since the Ermitaño project in 2016. The Navidad system is strategically located in close proximity to the existing Ermitaño mine, a factor that is highly encouraging for the potential of efficient and low-cost development. The significant commitment to exploration, with $49 million allocated in 2025, and underground development, with $74 million allocated, represents a proactive countermeasure against the systemic operational risk of mine depletion. This heavy investment ensures that the production growth through major acquisitions like Los Gatos, is sustainable and supported by new organic discoveries rather than being temporary. This strategic reinvestment into defining new ore bodies validates the long-term viability and growth potential of the entire asset portfolio.
The high-grade nature of the Navidad discovery, which added 29.7 million AGEQ ounces of inferred mineral resources in 2024, is particularly accretive to the company's overall grade profile. The reported grades of 81 grams per ton silver and 3.42
grams per ton gold are substantially higher than typical averages. The implication of higher grades is a direct pathway toward future AISC reduction, as high-grade resources require less tonnage to be mined and processed to achieve the same metal.
Yield. This reduces energy consumption, infrastructure strain, and overall processing costs per ounce. As the Navidad resource transitions from inferred to measured and indicated categories, leading to integration into the final mine plan, it is
expected to structurally lower the consolidated AISC below the current $20 to $21 range, thereby significantly widening future profit margins when the forecast high silver prices materialize. IV, Financial Health and Q3 2025 Performance Deep Dive. A.
Balance sheet resilience and liquidity. First Majestic's financial health is a critical component of its investment appeal, serving as a key differentiator within the capital-intensive mining sector. The company maintains an exceptionally liquid
position, reporting a record cash and short-term investment balance of $575.2 million as of September 29, 2025. This robust liquidity provides a strong financial moat against market downturns. The company's leverage profile is notably conservative.
Total debt stands at a manageable $216.8 million, translating into an extremely low debt-to-equity ratio of just 7.2%. This ratio has been aggressively managed down over the past 5 years, starting from 18.6%, demonstrating a clear commitment to
balance sheet de-risking and robust capital stewardship. Furthermore, the company's debt service capability is excellent, with interest payments covered 44.9 times by earnings before interest and taxes, EBIT. The record cash position exceeding $575
million substantially surpasses the total debt of $216.8 million. This strong net cash position provides the company with significant strategic optionality. It not only mitigates geopolitical or unexpected operational risks, but also enables First
Majestic to fund all of its aggressive 2025 capital expenditure program internally. The company can pursue future merger and acquisition opportunities without the need for external debt financing or dilutive equity raises, providing operational
flexibility regardless of short-term commodity price volatility or access to capital markets. This financial strength acts as a crucial buffer against unpredictable geopolitical risks inherent in operating primarily within the Mexican jurisdiction. B. Nuanced view of earnings performance. While the company reported Q3 2025 net earnings of $43.0 million, which resulted in a headline earnings per share (EPS) miss relative to analyst forecasts, a comprehensive review of the financial statements
reveals a materially stronger underlying performance.
The reported net earnings figure excluded a substantial $56.6 million in unrealized gains derived from the company's portfolio of marketable securities. These unrealized gains were instead captured within the Other Comprehensive Income section of the financial statements. This exclusion, combined with the strategic decision to hold over $50 million in finished inventory, means that the company's total comprehensive financial performance was substantially stronger than the headline EPS figure indicated. The inclusion of the $56.6 million in unrealized gains, an amount nearly 132% of the reported net earnings of $43.0 million, illustrates that the reported results are heavily influenced by non-core, non-cash portfolio volatility. This requires investors to look beyond the standard EPS metric and review comprehensive income to fully gauge overall profitability. The volatile nature of these investment gains or losses can, at times, obscure the profitability of the core mining operations. However, in Q3 2025, the effect was a substantial boost to the overall comprehensive financial health. Despite the headline earnings shortfall, First Majestic generated robust operating cash flows of $141.3 million before accounting for non-cash working capital and taxes in Q3 2025, underscoring the fundamental health of the mining operations.
The negative stock market reaction to the Q3 EPS miss highlights a potential short-term divergence between analyst focus on quarterly results and management's long-term strategy of maximizing asset value by holding inventory in anticipation of higher prices. Management appears to be operating with a high conviction regarding the future price of silver, willing to absorb short-term analyst disappointment for a potentially much greater financial payoff in subsequent quarters. V. Capital allocation and organic growth strategy. A. Resource pipeline and discovery metrics. A hallmark of First Majestic's strategy is its commitment to aggressive resource delineation and long-term mine life extension. As of December 31, 2024, the company successfully increased its proven and probable mineral reserves, measured in silver equivalent ounces, by 45%. This significant accretion was a direct consequence of the successful 2024 exploration program and the strategic integration of the Los Gatos acquisition. The Navidad discovery at Santa Elena serves as a major long-term catalyst. This high-grade system added 29.7 million AGEQ ounces of inferred mineral reserves in the 2024 estimates. The discovered resource is characterized by impressive grades, including 81 grams per ton silver and 3.42 grams per ton gold. Management has emphasized that the full extent and geometry of the Navidad system are not yet fully understood, and the exploration potential remains open in all directions.
This suggests substantial upside potential that will be realized through ongoing drilling. Resource estimate updates specifically for the Navidad project are expected in March of the following year. B. Capital expenditure strategy, 2025 guidance. The 2025 capital guidance reflects a highly growth-focused approach, representing a 34% increase in expenditures compared to the revised 2024 guidance. This elevated budget is aligned with the company's future growth strategy, which is underpinned by aggressive exploration and development activities across the portfolio, particularly at Santa Elena and San Dimas.
The capital is strategically divided to support both sustaining and expansionary activities. The budget allocates $49 million specifically for exploration activities and $74 million for underground development. This aggressive reinvestment strategy, which includes a total planned drilling program of 270,000 meters across all key projects, is explicitly designed to sustain operations for decades and discover new ore bodies. The exploration methodology is benefiting from new geological models at Santa Elena, which led directly to the Navidad discovery. V. Investment risks and geopolitical considerations. A. Valuation and execution risk. The single greatest inherent financial risk to First Majestic Silver is its valuation premium. With a price-to-earnings multiple approaching 115 times earnings, the market expectation is set exceptionally high. This demanding multiple dictates that the company must deliver flawless execution on production targets and cost management. Any deviation, such as an operational delay or unexpected cost overrun, risks triggering a significant de-rating of the stock. Compounding the valuation risk is the inherent commodity volatility. Silver's price fluctuations are generally more pronounced than those of gold, creating magnified risk exposure for a pure-play producer.
While current forecasts support a strong bull market trajectory, any unforeseen macroeconomic shock, such as a sharp pivot in central bank policy leading to dollar strength, or a sudden reduction in industrial demand, could trigger a steep correction, which would disproportionately impact First Majestic's highly leveraged margins. B. Jurisdictional and operational risk. The concentration of First Majestic's material properties, including San Dimas, Santa Elena, Los Gatos, and La Encantada, in Mexico, exposes the company to specific jurisdictional risks. Changes in local or national regulatory frameworks concerning mining policy, labor laws, or environmental standards can materially affect operational costs and feasibility. Standard operational risks, including mine depletion, technical failures, and unexpected labor interruptions, remain potent threats. Specifically, the company's ability to counter the natural decline of producing mines relies heavily on the continued success of its exploration programs, particularly the effective delineation and development of recent discoveries like Navidad. The company's exceptionally strong liquidity and minimal net debt position provide a crucial buffer against the unpredictable nature of geopolitical risk in its primary operating jurisdiction. Regulatory changes, such as the imposition of new taxes or unforeseen environmental compliance requirements, often necessitate significant and immediate capital outlays.
First Majestic's ability to internally fund these unexpected costs using its substantial cash reserve of over $575 million, rather than relying on external and potentially dilutive emergency financing, significantly reduces the potential financial damage caused by jurisdictional uncertainty compared to its more leveraged peers. This fortress balance sheet acts as an essential de-risking element for its high concentration in Mexican assets.
VI. Valuation Framework and Conclusion. Valuation Justification. Based on traditional trailing earnings metrics, First Majestic is unequivocally expensive, with PE multiples approaching 115 times earnings. However, applying a purely historical earnings-based valuation framework is insufficient for a growth-oriented mining company on the cusp of a potential commodity supercycle. A rational assessment necessitates utilizing net asset value (NAV) methodologies and forward-looking discounted cash flow (DCF) models that incorporate the anticipated high silver price forecasts, specifically projecting prices in the $60 per ounce range. The significant premium valuation is fundamentally justified solely by the anticipation that the company will realize the upper limits of its projected 71.16% earnings growth. This growth is expected to be delivered through the radical expansion of operating margins, resulting from the widely predicted structural bull market trajectory for silver prices. Investors are essentially purchasing maximized leverage to the future price of silver, rather than buying current earnings. B. Final assessment. First Majestic Silver Corp presents an investment opportunity built upon a potent combination of aggressive production growth, a strategically leveraged cost structure, and an exceptionally robust financial foundation.
The company achieved a 39% year-over-year production increase in Q3 2025, supported by a fortress balance sheet distinguished by a highly conservative 7.2% debt-to-equity ratio and over $575 million in cash. Furthermore, the addition of proven high-grade resources such as the Navidad discovery ensures long-term asset longevity and a pathway toward future cost reduction. The investment conclusion is fundamentally a direct, highly levered call on the sustained and significant revaluation of the silver price. With an all-in sustaining cost consistently competitive at approximately $20 per ounce, the company benefits from exceptional operating leverage, meaning every dollar increase in the silver price above this threshold generates disproportionate cash flow expansion. Given the structural supply deficit, accelerating industrial demand from green technologies, and consensus analyst forecasts pointing toward a 2026 silver price range of $55 to $65 per ounce, First Majestic is poised for an explosive expansion of free cash flow. This stock functions as a high beta vehicle designed for institutional portfolio managers seeking maximized pure-play exposure to silver's industrial and monetary revaluation. This recommendation is issued with the caveat that investors must accept the inherent risks associated with its demanding valuation multiple and the concentration of its operational assets in the Mexican jurisdiction.